Two people, same starting point, $50,000 in savings. One buys a rental property, the other buys index funds. 20 years later, one of them has more than double the net worth of the other. By the end of this video, you'll know exactly which one, and more importantly, you'll know why, because I'm going to walk you through the actual math. Not the Instagram guru math, the real math. If you've ever asked yourself, should I be buying property or should I be investing in the stock market, this is the only video you need to watch. Let's get into it. Here's why this question is so confusing. Everyone in your life has an opinion. Your uncle who bought a house in 2012 swears real estate is the only way to build real wealth. Your coworker who's been dumping money into the S&P 500 says stocks are the easiest, most hands-off way to get rich. They're both kind of right, and they're both leaving out huge parts of the story. So today, we're comparing these two the way nobody actually does, side by side with real numbers, factoring in the stuff most people forget: leverage, taxes, fees, your time, and risk. By the end, you'll have a framework to decide which one actually fits your life, because the honest answer is, it depends on the person. But the math is not a mystery. Let's break it down. Let's start with the number everyone wants to know. Which one grows faster? Stocks, S&P 500. Historically, the S&P 500 has returned an average of about 9 to 10% per year, going back nearly a century, including dividends before inflation. After inflation, you're looking at roughly 6 to 7% real return. Real estate, U.S. home prices nationally have historically appreciated around 3 to 5% per year, pretty close to inflation. On paper, stocks win this round easily. But, and this is the part almost every YouTube video skips, that comparison is misleading. Because when you buy a stock, you buy it with 100% of your own cash. When you buy real estate, most people buy it with 20% down and a mortgage. That means your real estate return isn't measured against the full property value. It's measured against the cash you put in. And that changes everything. This is called leverage, and it's the single biggest reason real estate investors can outperform the raw appreciation numbers. Let's run real numbers. Scenario A. You buy $400,000 in stocks with $50,000 cash and no loan, because you generally can't get cheap leverage on stocks the way you can on real estate. At 8% average annual return, in 10 years that grows to roughly $107,000. Scenario B. You buy a $400,000 property with $50,000, 12.5% down. Closing costs and financing rolled in, loan covers the rest. The property appreciates at a conservative 4% a year. After 10 years, that property is worth around $592,000. Your equity isn't just the appreciation. It's appreciation on the full property value, plus whatever mortgage principal you paid down along the way, which on a 30-year loan is usually another $60,000 to $80,000 over that period. Added up, roughly $190,000 in appreciation, plus $70,000 in principal paydown on a $50,000 investment. That's the leverage effect. You're earning returns on money you didn't even put in. But, and I want to be very clear here, leverage cuts both ways. If that property drops in value 10%, you don't lose 10% of your money. You could lose 80% of your equity because you're leveraged 8 to 1. This is exactly what happened to millions of homeowners in 2008. Leverage amplifies gains and losses. It's not free money, it's a multiplier, and multipliers work in both directions. This is where real estate math falls apart for a lot of people, because they only count the appreciation and forget everything else. Owning property comes with real, ongoing costs: property taxes, typically 1 to 2% of home value per year. Maintenance and repairs, usually budgeted at 1% of home value per year. Insurance property management, if you're not doing it yourself, typically 8 to 10% of rental income vacancy periods where you're paying the mortgage with no rent coming in. Closing costs to buy and sell, often 6 to 10% combined stocks, by comparison, are almost frictionless. With a modern brokerage, you're paying close to zero in fees, no maintenance, no tenants calling you at 11 p.m. about a broken water heater. This is the trade-off. Real estate can out-earn stocks because of leverage, but it demands cash, time, and active management to actually capture that return. Stocks are nearly passive. Here's a question people don't ask enough. What happens if you need your money now? Sell stocks, money's in your account in 2 days. Sell a house, you're looking at weeks or months, agent commissions, inspections, and a buyer who can back out at the last minute. Real estate is also concentrated risk. One property, one location, one local job market, one roof. If that local economy tanks, your entire investment is tied to it. Stocks, especially index funds, are automatically diversified across hundreds or thousands of companies, across every industry, instantly. So if flexibility and diversification matter to you, stocks win. If you're comfortable being illiquid for years, in exchange for potentially higher leveraged returns, real estate can win. Here's the honest answer, and I promised you real math, not a sales pitch. It depends on how you use each one. If you buy real estate with smart leverage, positive cash flow, and you hold long-term, it can meaningfully outperform stocks because you're compounding on borrowed money. If you buy stocks consistently over decades in low-cost index funds and never touch it, you get the second best return in the game, with almost zero effort and almost zero stress. The real losers in this debate aren't people who chose real estate or stocks. They're people who bought a property they couldn't afford, with no cash reserves, and got wiped out by one bad year. Or people who panic sold their stocks in a downturn and locked in losses. The actual best strategy for most people watching this? It's not real estate versus stocks. It's real estate and stocks, because they behave differently in different markets, and that combination reduces your overall risk while capturing both types of growth. If this video actually helped you understand the math instead of just picking a side, that's the goal of this channel. Every week I break down exactly how money actually works, no fluff, just the numbers. Hit subscribe if you want to keep building real financial literacy with me. And drop a comment. Are you team real estate or team stocks? I read every single one. Next video, we're breaking down renting versus buying, the real math, so you know exactly which move makes sense for where you are right now. I'll see you in the next one.